The joint U.S.-Israeli airstrike on Iran has directly pushed international oil prices higher. Combined with sticky U.S. inflation and the pass-through of tariff costs, market expectations for Fed rate cuts have cooled significantly. The view that rates will stay higher for longer is now the dominant consensus. The conflict has sparked a global energy supply scare. Brent crude futures have surged, WTI crude has followed suit, and fears of disrupted shipping through the Strait of Hormuz continue to mount. Higher oil prices will quickly pass through to consumers, putting clear upward pressure on U.S. gasoline prices. With U.S. inflation already running above target, services inflation remaining stubbornly high, and tariff-driven costs gradually feeding through to end users, the inflation fight had already stalled. Rising oil prices only make matters worse. Looking at the transmission mechanism, sustained higher oil prices will directly lift overall inflation. If oil breaks through key thresholds, global inflation will face significant upward pressure, making the Fed's job even harder. Markets have quickly repriced the expected path of Fed policy. The probability of a March rate cut has effectively hit zero, and expectations for a June cut have also cooled notably. The first rate cut is now likely delayed until the third quarter or even later. Hawkish voices within the Fed are growing louder. Most officials insist on clear evidence that inflation is returning to target before considering easing. Persistently high oil prices give them ample reason to keep rates elevated, while arguments for an early cut are losing support. The Fed is now caught between the dual constraints of inflation and growth. While energy prices aren't directly in the core inflation metrics, gasoline prices have an outsized impact on household inflation expectations. If inflation stays elevated, a premature rate cut could risk repeating the mistakes of the 1970s. On the other hand, higher oil acts as a hidden tax on households and businesses, squeezing incomes and profits, and weighing on aggregate demand. If policy becomes too tight, it could amplify downside pressure on growth. Balancing these risks, the Fed will likely maintain its data-dependent, wait-and-see stance. The March meeting will deliver a hold, the number of rate cuts for the year will be significantly reduced, and the first cut will be pushed well back. If the conflict escalates further and leads to a prolonged blockade of the strait, a rate cut this year could even be completely taken off the table. Compared to previous geopolitical shocks, this one has more staying power. With U.S. inflation already elevated, tariff pressures present, and services inflation stubborn, even if the conflict remains contained, the period of high rates will last far longer than markets had previously anticipated. In terms of asset pricing, gold will remain strong on geopolitical risk, while U.S. stocks and emerging market currencies face pressure. Market volatility will increase markedly. Treasury yields will likely trade in a range in the near term, with the curve flattening as short and long ends diverge. Going forward, markets will focus on the progress of U.S.-Iran talks in early March, signals from the March FOMC meeting, and the trajectory of oil and inflation data. If oil and core inflation remain elevated, rate cut expectations will be pared back further. In summary, the U.S.-Iran conflict has reignited inflation fears through the oil channel, sharply reducing the odds of Fed rate cuts. Higher for longer will be the dominant policy theme for the first half of the year. The market's pricing logic is shifting from liquidity-driven easing to the dual constraints of inflation and policy. Elevated volatility and structural divergence are set to become the new normal.